You may have seen the videos that say that Wall Street homebuyers are selling homes at big losses. That may be true in some cases, like BlackRock. Yet at the very same time, there are investors that are making money in this housing market. Yes. Here's just one example. Blackstone, who is preparing a record $50 billion to scoop up real estate bargains during the downturn. And here's how you may be able to lock in on higher yields compared to some of that big Wall Street money. So give me a thumbs up. Now, if you've been looking at real estate and you're priced out of the market, it may be time to pivot. There are some that are going to make money, and there's some that are going to lose money investing in real estate. You just need to be on the right side. Now, residential real estate has arguably been the most valuable asset segment of the real estate class recently, and historically as well. Its popularity is driven by disproportionate amount of capital into the residential real estate, particularly from institutional funds who are really pushing up values and pushing up rentals higher and lower yields. So some real estate investing giants, amazingly, continue to buy up homes, even with high inflation, even with higher mortgage rates, even as we hear the word recession. Now, something that is likely and is here to stay is real estate. So I just want you to picture this. The fact is, Blackstone is close to finalizing what could be the biggest traditional private equity real estate investment fund in history, and this is according to the Wall Street Journal. In a regulatory filing last month, Blackstone said it has secured $24.1 billion of commitments for the latest real estate fund called Blackstone Real Estate Partners X. Now, combined with Blackstone's real estate funds in Asia and Europe, the company will have over $50 billion available for opportunity investments. So, in the event of a market downturn, Blackstone is looking at plenty of capital ready to scoop up some of those attractive real estate bargains. But earning a good yield isn't as easy as it once was. Considering today's economic climate, the gross rental income, for example, in a typical New York apartment is just 2.9%. The dividend yield on residential REITs, R-E-I-T-S, is also very mediocre. Yet Blackstone invests primarily in stabilized, income-generating real estate investments in many asset classes in the United States. Many big and small investors are starting to look beyond commercial properties and common rentals. There are some niches that could offer better returns over the long term, things that may not seem traditional, like specific oceanfront properties. Even smaller investors are looking at condos in Myrtle Beach, South Carolina, which can produce gross rentals that can range anywhere from $30,000 to $150,000. Now, these types of properties have not been what many investors would consider to be even traditional. But currently, a big problem for many real estate investors is the low single-digit yields that are really tough to swallow in this environment when you consider that interest rates are rising and inflation is at 9.1%. So what do the latest moves in the economy mean for the future of real estate investing? Many investors are starting to think out of the box. They're using their head. Consider healthcare properties. Healthcare is one of the most defensive sectors in real estate. Recessions and credit cycles don't have much impact on emergency healthcare services. Think about it. Hospitals and clinics make ideal real estate investment targets. Why? Because the economy can be up or down, it's going to work. Something not traditional, obviously, cannabis warehouses. I know, listen, cannabis, legal cannabis that is a volatile sector. It can be very highly regulated and an intensely competitive industry, but cannabis stocks have really disappointed many investors. That's not what we're talking about. By comparison, leasing warehouse space to these cannabis producers has proven to be a better business model. How about mortgage holders? This is one that's consistent all the way through. Most real estate investors really focus on the equity portion of a property that they acquire. So in other words, they put their money down on and buy properties. They pay interest on the mortgage, they collect rents, and this is what would be considered the traditional landlord model. However, some direct mortgage holders are focusing on acquiring mortgages and collecting monthly payments. Now, it's obviously secured by the property. If it goes bad, they can take it back. This is an idea that could lead to better yields if managed properly. Can't talk. How about this? Beach house or an oceanfront condo as an investment. Now, stocks can be volatile. Cryptos are making huge swings either way, and even gold is not immune to the ups and downs of the market. That's why, if you're looking for the ultimate hedge, it could be worthwhile to check out an overlooked asset totally: oceanfront properties. Why? The lure of the beach and ocean is not going away. They only made so much of it, and they're only going to be making so much of it. But it is a becoming popular way to diversify, not saying all eggs in one basket, because it's a real physical asset with little correlation to the stock market. Have you ever wondered who owns that beach property that you enjoyed for your vacation? You know, investing in oceanfront properties isn't just for the likes of the ultra rich. Here in Myrtle Beach, South Carolina, you can still find income-producing oceanfront condos from $150,000 to $300,000. It's probably the least expensive in the United States. Many have been looking for investment with dividends like family fun, rest and relaxation, and income. Now, like everything in the real estate sector, there's good, there's average, and then there's way above average. So choosing any property, no matter what you do, it's not going to give you the same results. But I can tell you that I personally have been investing in real estate for the last 36 years. When the market was up and when the market was down, I still made money. Now, whatever you do, don't get crushed by inflation. We've all seen the clickbait videos with talking heads who don't actually own any real estate. They don't eat their own dog food, and they don't even own any investments. It's what I would call the big hat, no cattle. Think of the Wild West, think of Texas. So, what are you planning on doing? Are you still looking to buy or sell real estate? Or are you sitting on cash? Are you already invested with massive cash flow? What is your game plan? Now go ahead and comment below because I want to know. I'm super curious. What do you plan to do to take advantage of these times? If you're looking to buy or sell anywhere in the United States, I have a network of real estate experts that I can hook you up with. Just pick up the phone, give us a call, even if it's just to chat about what's going on in the local market. Now, no matter where you are and whatever you're doing, I hope you're having a great day. If you already have subscribed, you already know this. There's over 1,000 super helpful videos here on this channel, so go ahead and click that subscribe button. And if you have subscribed, I'll see you in the next video. Take care, guys.